Concerns over the global economy are rising on the back of the World Bank's latest report, which downgraded global economic growth for this year to 2.9%. And we're joined by one of the report's main authors, lead economist at the World Bank, Carlos Arteta. Thanks so much for joining us today, Mr. Arteta. Now, your report says we could enter a period of stagflation. How close are we to stagflation, and what will really push the global economy into stagflation territory?
Well, thank you. And as you mentioned, we are in a very perilous juncture. 6 months ago, we expected low growth and high inflation. Now we are seeing a situation with even weaker growth and much higher inflation, based partly on the effects of the war in Ukraine and commodity prices, on supply disruption, and on increases in food and energy. There is indeed a risk that we may find the global economy in stagflation, that is, low growth and high inflation, in a way that resembles the 1970s. Now, the current juncture indeed resembles the 1970s in three key aspects. There are persistent supply side disruptions fueling inflation. They are preceded by a protracted period of highly accommodative monetary policy in major advanced economies. There are prospects of weakening growth. And this comes amid vulnerabilities in emerging markets with respect to potential monetary policy tightening in advanced economies. That being said, there are also some differences. The increasing commodity prices are much smaller smaller from those in the 1970s. The balance sheet of major financial institutions are in stronger health. And unlike the 1970s, central banks in advanced economies and EMDs have now clear mandates for price stability. And over the past decades, they have established a credible track record of achieving targets. That being said, additional supply disruptions may lead to higher inflation and to stagflation.
So how much of an impact will the interest rate normalization that's currently really underway across the globe have on inflation?
Well, inflation has climbed higher around the world, and in the current context, we see many advanced economies, central banks, and also central banks in developing economies tightening monetary policy substantially. Now, in the current environment of elevated inflation and higher interest rates, we could see even more tightening from major central banks. We have done a scenario analysis on these risks, and we see that the potential for financial stress in emerging markets is very elevated. In particular, if faster monetary policy tightening in the United States were to be combined with additional energy disruptions and more lockdowns due to COVID increases, we could see a much sharper decline in global growth. Global growth could actually be 2.1% this year and 1.5% next year, which is perilously close to a global recession.
Now, the future of the war and China lockdowns, these are, factors that we cannot foresee. Your report drops growth to 2.9% this year, and you expect that low growth to continue in 2023 and 2024. Is this forecast based on a continuing war, on high oil prices, on COVID controls in China? I mean, what does it really factor in?
This is an important question. These baseline projections assume that the war in Ukraine persists in the near term, but becomes increasingly contained in the eastern part of Ukraine. These projections also assume that the sanctions to the invasion are not lifted over the forecast horizon, and that geopolitical and policy uncertainty remain above historical norms, but gradually wane as the intensity of the war and its repercussions abate somehow. This outlook is also predicated on pronounced but orderly tightening of global financing conditions, and that commodity prices are expected to remain high but moderate over the forecast horizon as supply disruptions ease. And importantly, the economic impacts of COVID outbreaks are expected to be of markedly less severe effects than earlier outbreaks. And in that case, we could have this substantially slow down. It could even be sharper if some downside risks materialized.
Now, your report calls for changes in fiscal and monetary and climate and debt policy. I mean, there's a lot to cover here. What specific changes need to be made?
There are substantial challenges among emerging and developing economies and the world in general. We have seen that recently, in order to mitigate the impact of sharp increases in food and energy, a number of countries have cut taxes, have increased subsidies, and have imposed price controls, particularly in food and energy. These measures may be well-intentioned, but they can be counterproductive. They are costly and generally ineffective at delivering benefits for low-income households, and they can also be challenging to dismantle. It is more important to implement a targeted support for vulnerable households rather than distortionary price controls of subsidies. Developing countries can improve their social safety nets, make a big effort on that, and more generally, encourage diversification of food sources and promote efficiency in food production and trade in order to mitigate the risks for food insecurity. And in terms of monetary policy, there is, of course, an inherent trade-off between supporting growth and containing inflation. That being said, this trade-off can be improved in a number of ways. Communicating monetary policy decisions clearly within credible monetary frameworks and safeguarding central bank independence are critical, as well as improving and strengthening macroprudential regulations.
Thank you so much for your insights today and for joining us today, sir.
Thank you very much.